Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. What I would like to do today is go over 5 different companies that are very good companies, quality companies that are undervalued at the moment. Right now, if you look at the market, you will see the S&P 500 for the month is basically flat. The Dow Jones Industrial Average is down, as well as the Nasdaq is down as well. Just the flat. All of them are just slightly down, okay, just less than 1%. So what I want to do is just look at the opportunities that we probably haven't seen, or maybe we haven't literally considered. So I want to go over 5 companies that are undervalued at the moment, but please, as always, do your own research, okay? Don't rely on the information that I'm providing here, and always do your own research. If you haven't joined us on the Discord, please do it. It really helps, okay? All you need to do is just join on the Patreon account, okay, and then you can get access to all of these things, including the Sharia compliant ebook there, as well as basically joining us on the Discord. InshaAllah, that helps this channel massively. So what I want to do today, like I said to you, is go over 5 different companies. I don't want to make the video any longer, so I want to make it's short, and I want to go to over these 5 companies, and then at the end I'm gonna basically show you the halal side of things, so the halal screening from Zoya to see what they look like. So as always, we're looking at the company, the market cap, the moat of the company, the price, current price. We look at the dividend yield, we look at the payout ratio, which is a very important thing. I was talking to a friend of mine a couple of days ago, and he had a couple of companies that dividend companies, they cut their dividends. And we were talking about, when it gets to a situation where the company's dividend yield, the payout ratio is very high, I was saying to him, you know what, be careful in those situations, because the next thing they're going to do is cut that dividend. Because of course they can't sustain it. They have to use their net income to to pay those dividends. And if they're basically getting closer to above 70% or whatever, then just run away from those companies. Latest increase, so if they have increased that dividend and how much of it they've increased, we want to see the 5-year average. So the last 5 years, the compounded annual growth rate, what was it? How much have they included? The dividend growth rate, sorry, the dividend streak, as well as how long they have been increasing that dividend. We want to see the annual payout, so how much you will get for every share of that company that you own. Safety side of it coming from dividend, simply safe dividend, and profit margin, return on equity, and free cash flow as well. Then we look at total return in the last 10 years, and then the growth estimate for the EPS for the next basically 5 years, and the Morningstar valuation to finish things off. Let's start with the first company, and this is a company I've talked about for a while now in the last few months, and that's Thermo Scientific. This is in the healthcare side of things. Currently has a market cap of $196 billion, so it's a huge company. It has a wide economic moat, and price right now is $504 per share. Dividend yield is very low, of course, 0.28, but payout ratio is very low. The latest increase was 17%, which is absolutely huge, and the 5-year dividend growth rate is of 15%, which is absolutely huge. So when you look at this is amazing. So the payout ratio is very low, okay. The latest increase was 17%, and the 5 years average basically 5 years basically 15%, if I can talk. And then you've got 5, they've increased this for 5 years basically, and you can see that's why there's about 15% right now. The annual payout, we're looking at $1.40, and then safety, we're looking about 72%, which is safe. Anything above 60% or 61%, simply safe dividend gives it a green light basically. Profit margin 13%, return on equity 13%, free cash flow $5.85 billion, and total return in the last 10 years 18%. Now next year they're expecting the earnings to grow about 10%, then 6%. It's discounted right now about 16%, and $600 per share is basically where they think the price should be. That's about $100 from where it is right now, which is absolutely amazing. So dividend side of things is great. It's discounted right now. It has excellent free cash flow. Profit side of things are looking good. If you're interested, go and do a little bit more research on that company before you invest in it. The next one is the one I own, and that's Public Storage Operating Corporate Company, and the rate they have 46 billion market cap right now. Moat wise is A lot of the REITs will have none because anyone can start building and whatever, start that business easily. So basically barrier to entry is very, very, very low. Price right now we're looking at about $265 per share. Dividends almost over 4.5%. Payout ratio 70%. REITs up to 90% is fine. Okay. So latest increase 50%, 5-year growth rate of 0%, dividend growth is 0%. They cut recently, I think. Annual payout, we're looking at about $12 per share right now. Basically in terms of safety, we're looking at about 96%, profit margin 92%, return on equity 71%, free cash flow 2.8, total return in the last 10 years 8%. Next year they expected the earnings to grow about 2%, then 17% after that, which is absolutely huge, which is one of the reasons I own, as well as of course that dividend, and 17% discounted right now. $317 per share is where the price should be going forward. The next company we're looking at Electronic Arts, and this is one of the companies, if you're young enough, whatever, you've been around and you played games, you've definitely used their games and you remember the theme whenever you open that FIFA game, whatever. 32 billion market cap, narrow economic mode, $120 per share, dividend yield of 0.64, payout ratio 12%, latest increase 0, 5-year growth 0, 2 years of increase in that dividend. Annual payout, we're looking at about 0.76. Safety 80%, profit margin 8.8%, return on equity 11.9%, free cash flow, we're looking at about $1.7 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 16%. Growth estimate for the next 5 years, next year basically expecting 12%, then 6% after that, 21% discounted right now. $150 per share is where the price should be. And this is one of those companies that just goes under the radar. I wouldn't be surprised if it's another target for one of the big boys to acquire this company, just like Activision Blizzard. So it will be interesting to see what happens to it in the next few years. The next company is one I own in the portfolio. That's S&P Global, 118 billion market cap, wide economic mode, $372 per share right now. Dividend yield just below 1%, payout ratio only 30%, and latest increase was about 6%. Now, the 5-year growth rate, basically, growth rate is 15%, and dividend streak of 50 years. It is 50 years. It's not 49 right now. It is 50 years, but Simply Safe Dividend says 49, so I'm going to keep it, but should be 50 years, or it was about to become 50. Annual payout, we're looking at about $3.60 for every share of that company that you own. Safety 99%, profit margin of almost 20%, return on equity about 7%, free cash flow is $3.18 billion. Total return in the last 10 years about 20%, which is absolutely amazing. Growth estimate for next year is about 16%, then 13% every year after that. 1% discounted right now, $175 per share. 172 is where it is right now. So just a little bit undervalued at the moment, or fairly valued if you want to call it that. The next one is Starbucks, the company that we all know, $107 billion market cap, wide economic mode, $94 per share. This has come down quite a bit. This company is getting very, very interesting. Dividend yield of 2.26%. Payout ratio 64%. Latest increase was 8%, which is really good. Then 5-year growth at about 14%. So when it comes to the dividend side of it, it's actually quite nice. The payout ratio is slightly high, 64%, but we'll see. Hopefully in the next few years they can bring that down. They have increased this dividend for 12 years in a row. Annual payouts $2.28. Safety 67%. Profit margin of 10%. Return on equity basically is a negative. Shareholder values are going on there. Free cash flow right now we're looking at about let's call it about $3 billion. Total return in the last 10 years we're looking at about 11%. Growth estimate for next year is about 19%. Growth estimate for the next 5 years about 15%. Discounted right now about 10%. $103 per share. Now I'm doing a full video on this company because there are a couple of things I want to look at, because some people think it's not Sharia compliant. So I want to check that out completely and utterly, see the business and from what they sell and where their revenue comes from and so on. So that's number one. And the other thing is I want to see if it's actually good value for because I don't have that many consumer discretionary companies, and this one is getting interesting. Okay, I do have Nike and Home Depot, but I don't have any other companies, and this has come down quite a bit. So I'm gonna look at this company again. If I'm gonna do full dive in for video soon, inshallah. If you're interested, let me know. And now some of the community have already said, look at this company. Let me know what you think from Sharia compliance side of things as well. Right. Let's now look at Sharia compliant. So every single one of these companies, including Starbucks, have absolutely no issues. The debt levels for the interest-bearing debt is actually highest when it comes to Starbucks out of all of them, but the rest of them are absolutely fine. 13%, 16%, or 17%, if you want to call it interest-bearing securities. No issues with that as well. So there you have it, 5 great companies. They are all undervalued at the moment according to Morningstar valuations. Go away, do your own research as always. Okay, I want to show you very quickly one more thing. So for each one of the companies, you can see the end, basically the revenue is heading the basic upwards. In terms of EPS is also heading the right directions, and that's what we want to see when moving forward. Okay, that's what we want to see. So if we look at public storage, okay, if you scroll down, I'm using Seeking Alpha, you can see it's heading the right direction. If you go to annualized, if you take out the estimates, you can see it's been heading the right direction, and basically the estimates are also heading the right direction. If we look at and again, so a lot of these companies are very cyclical, so you will, one year they might be down, another year they might be up depending on the economy. This one, is it flat? No, actually it's going up, as well as the EPS. You can see is expected to go up in the next couple of years. What else do we have? SPGI, S&P Global. I just want to show you these things because it is important to have the full picture, and hopefully will help you decide what you want to do with these companies. So again, you can see how amazing. Look at this company, from $6 billion to right now $11 billion, and expected to be about $13 billion in basically in 2 years time, which is absolutely amazing. This is one of the reasons why I love this company. I hope it comes down a little bit more so I can add more. Again, the same thing is actually doing well. And the final one is Starbucks. Starbucks situation is very difficult because of what's happening in China. So it'll be interesting when I do a little bit more research. I'll let you know. But it's because they have a massive consumers and customers in China, they rely on China a lot, just like Nike and so on. So I'll be looking at that. But still, look, they expected from $32 billion to $35 billion to $39 billion of revenue side of things in the next 2 years. And then you can see for exactly the same, okay, from EPS of right now, the actual was $2.87, $3.45, $4.10. Wow. Okay, I'm definitely going to look at this company again, inshallah. I'll let you know what I think about it. There you have it. That's the 5 basically companies that I wanted to talk to you guys about. Please do your own due diligence, do your own research before you invest in any of the companies, and support the channel. Please do everything you can to support the channel because it takes a lot of time and effort to put these things together. I would really appreciate if you could just join us on the Discord, join us on the Patreon account. Okay, it doesn't take a lot. Just when you join it for the first month, you might find some value, and then if you don't like it, you can always change your mind. You're not under contract or anything like that. Have a wonderful day. Assalamu Alaikum.